Good morning, everyone. It is, I believe, 8:30 and time for us to begin. We'll presumably have a good number of people joining us over the next few minutes, but most of them don't want to hear me anyway, so I will carry on and we can get going at the allotted time. So, good morning, everyone. Welcome to the latest seminar from K. Johnson G, part of our series of events for clients and contacts, helping you build a better business. This morning, we are delighted to welcome Matthew Cady, investment strategist at Brooks Macdonald. Again, he returns after an excellent seminar he kindly ran for us a few months ago. It's not that often, Matthew, we invite people back, so you did very well. No pressure for this morning. Matthew will be looking at how investors will approach the post-pandemic world and give an overview of what we might expect in the investment environment in 2021. There'll be space for questions at the end, and we aim to finish by 9:30 at the very latest. So, ladies and gentlemen, please give a online, silent but raucous welcome to Matthew Cady from Brooks Macdonald.
Thank you very much, Stephen. Hope you can, just a quick sound check, you can hear me okay and the screen looks okay. Good, excellent. I will endeavour to keep my screen on, but with children logging online for school, Zooms and webinars, I may have to cut the video, but we'll see how we go. We'll keep it running for now. Thank you very much, everybody, for taking the time out of your day to listen to me. So I've been given a brief, it's an hour. I plan to hopefully walk you through some of the key messages over the next 40 minutes, 45 minutes, and then we'll have maybe 15, 20 questions, 15, 20 minutes for Q&A at the end. In terms of the slide pack, it's quite a lengthy slide pack. Just as last time, I don't plan to go through each slide in order. I'm much rather actually keen to use it as a resource, and we'll jump around to cover some of the key themes. And hopefully I've got enough slides in the pack to arm myself for the questions that will follow afterwards as well. But very happy for this pack to be shared after the presentation. And then if you have any questions afterwards that aren't covered in the webinar, then please do reach out to your BM contact, and I'd be delighted to come back to those in turn. So thank you very much. So let's get into it. There are, just as last time, I think there are three key messages that I want you to try and take away from this presentation. The first is that there is a need for balance in portfolios. The way that the markets are evolving in terms of their recovery from the pandemic, maybe that's a preemptive word, if you will, because clearly we are still in the midst of second, third waves. In terms of new variants, this tug of war between the vaccine and new variant case growth, and every day you're kind of watching to see which way that tug of war is tipping. But I think if last year was very much a year which characterised the emergence of the pandemic, this year is hopefully going to see at least the start of its demise. But the pace of which that carries, I think, is still not certain. You know, that the phrase 2 steps forward, 1 step back is probably going to be something that we will reflect on over the course of this year. So I think, given that, it's very hard to put both feet into one particular camp, either a defensive risk-off camp or a more aggressive cyclical risk-on camp. So I think there is a need for balance in portfolios. We express that at Brooks Macdonald in terms of a barbell strategy. So we think actually you can have the best elements of both. So the best elements of growth and on the one side, and defensive characteristics on the other side, the best characteristics of value and cyclical exposure. For example, in terms of thinking about regions around the world, there are areas that you can pick up cyclical and value exposure. Not all of those are equal. and we'll come on to that in due course. So there is a need for balance in portfolios. That's the first point. The second point is that this is going to be a year of transition. At the very least, how policymakers, so central banks, how governments transition from an environment where you've effectively had a huge levels of support delivered to businesses and to consumers through the pandemic, how you transition to that huge pro-accommodation stance to an environment post-pandemic at some point whereby you're back to a new normal, whatever that means, and you are taking your foot off that accommodation pedal and you're thinking about sort of life beyond that in terms of making your borrowing needs and your financing needs sustainable, how governments introduce an element of fiscal prudence, if you will. I know that was a phrase that I think Boris Johnson used last year in terms of, you would expect prudence, fiscal prudence from a Conservative government, and that's what you're going to get. So how quickly we move from one state to the other state, from a pre-pandemic accommodation state to a post-pandemic, from a pandemic accommodation state to a post-pandemic state whereby you're having more prudence and more measured accommodation. You're going from one to the other is not going to be easy. That transition is, I think, going to be, in some senses, a bit of a minefield in terms of unintended policy errors. You saw at the start of this year in terms of the Federal Reserve. I think within the space of a couple of weeks, we've done a whole round trip, hadn't we, in terms of concerns about tapering, how quickly the US Federal Reserve might either take its pedal off in terms of QE, in terms of guidance for future interest rate direction in the years ahead. And then very quickly, the market started to get concerned by that. And then within the space of a week, you had various Fed governors rolling out the narrative, well, it's not anytime soon, and remain very mindful of the need to provide support for the economy. So this year will be a year of transitions. You've got one, need for balance of portfolios; two, mindful that there are transition risks. The third point is, I think, the overarching point is that against all of this, there is a constant which you picked up, will have picked up from the last webinar, and which is the same this webinar, which is that we have a continued preference of equities over bonds in terms of the earnings yield differential and the environment, frankly, which I think is going to continue to favour equities. So with those three things, so balance, transition, and relative preference for equities over bonds, let's go into some of the slides. There are a few themes I want to pick on, so I will, if some of you have the pack, I will be moving around the pack, but hopefully we can follow it on screen. Let's go through to, let's see if I can do this. Right, I'm going to have to go to slide 5. So first of all, vaccine rollouts. I think what's very clear is that there is a varied pace in terms of the rollout that we're seeing, and this relative differential in pace of vaccine pre-orders in terms of vaccine immunization, that speed and pace is differing from country to country, region to region, and that risks driving a difference in terms of recovery trajectory. So, for example, on the screen here, this is from Deutsche, and this is looking at pre-orders in terms of doses per capita. So you can see at the top of the screen, US and UK have between 6 to 7 doses per capita pre-ordered. This was as at the middle of January. Compare that to the EU, to other countries around the world, which are materially less. So there is a sense that some countries are already, just as they might be fiscally, they are potentially in a better or relatively worse position in terms of having access to vaccines in order to progress those immunization programs. That's very clear on this slide, and this is again looking at the, I guess, the actual pace of immunization rollout. And what's very encouraging is I mean, Israel is right there at the top left. They went very hard and very early, and depending on what you read, they clearly paid a very full price for some of their vaccine order pipelines. But already you're seeing very encouraging results in terms of death rates now in Israel. Very small percentages now are due to those who've actually had the vaccine. So the vast majority of deaths in Israel on one latest study was effectively coming from those that hadn't had exposure to a vaccine dose. So that's really encouraging. And as you look across this curve, I think longer term, you'd hope that this would start to even out as countries catch up. But the longer we go through 2021, if this profile does see that this sort of shape maintained at least the first couple of quarters, I think you're going to have a real sort of difference in terms of speed of economic recovery, because as you get access to vaccines and as you immunize your populations, you try to get herd immunity, you can then think about opening up your economies. And already in Europe, for example, which has been the headlines the last couple of weeks, which has had perhaps a more troubled start in terms of the vaccine rollout, they're still seeing quite strong adherence in terms of extensions to lockdowns, for example, that we've seen in Germany recently. Let's go to this slide. So
Matthew, I'm sorry to interrupt. Sorry, sir.
Yeah.
Your volume is cutting in and out a little bit again. I don't know if it's just broadband or if you hide your beautiful face, whether that helps with the broad. I don't know what it is. Obviously, I don't know if you've had that before with some of these. It's just the volume drops drastically and then comes back. It's as if it's cutting in and out a little.
Yeah, okay, let's just try to stop the video and let's see if that works.
Okay, sir, thank you.
Right, and I'm just going to stop sharing. So I want to reshare with the actual pack itself. So let's just quickly do this. Let's go to screen one. Okay, right, so we're on this slide. Hopefully, if the sound doesn't pick up, let me know, but I'll try to speak more.
So far, so good, Matthew.
Perfect. So I think what you've got, there is a real sense of difference in terms of speed of rollout of vaccines, but also there is a difference in terms of the speed and the intensity of the fiscal response. So you saw this slide the last time I presented. I've updated
Matthew,
it.
Sorry, it's me again. I do apologize. I'm like a really obnoxious heckler, haven't I?
No, not at all.
You're not screen sharing, I don't think, unless it's just me.
Hang on, let's just go here. Right, let's just try this. Hang on. Let's do this. Right, let's go share screen and share. And let's do this. Right, how's that?
That's perfect.
Right, apologies for that, everybody. Right, so just to pick off, so where we're at, so we've got the difference in speed in vaccine rollouts. We've also got, I think, a difference in speed in terms of fiscal response. And this is also key, and this is what also guides Brooks Macdonald's Asset Allocation Committee in terms of thinking about the relative weights that we apply, especially for equity exposure regionally and across countries. And this screen was updated from the IMF, the International Monetary Fund, at the end of January, and this is clearly pre the potential next slug of fiscal response that's going to come from the US administration, the new US administration, Biden, who's looking at $1.9 trillion potentially of additional fiscal stimulus. But this captures the $900 billion that was agreed by US lawmakers back in December. But you can see here there is a significant difference in terms of the level of discretionary fiscal response. So looking at additional spending and foregone revenue, but excluding loans, equities, and guarantees. The USA is up around 16 points, 16% of GDP. Compare that to some European countries, for example, such as Spain or Italy, which are down in sort of mid-single digit. And just on that point, I think that it's a very interesting point to nod at the EU recovery plan. The EU recovery plan was agreed in July last year. They are still agreeing to how each country wants to spend the planned disbursements, and that has to be submitted to the European Commission by April, and then I think those disbursements then really start get going in the second half of this year. But the actual level, the actual scale at 750 billion euros of EU recovery fund, when you split it out between loans and grants, the grants is around 1%, just over 1%, maybe 1.5% of EU GDP in 2019 levels. And that's over the next 3 or 4 years. Compare that to the scale that you're seeing out of the US, for example, and there is a significant difference. So the concern that one might have is that some regions are not only faring better in terms of their fiscal response relative to other countries, but also the speed of their vaccine rollout programs as well. And I think these are really, really important to keep in mind. So when you are thinking about equity allocation across countries and regions, the pace of rollout, whether it's fiscal or whether it's vaccine, I think will have a very big bearing. The other key element when you're thinking about markets right now, and clearly markets are setting new highs already this year. We've seen both technology stocks and broader indices at new record levels. I think there are some slides which kind of help understand the direction and the speed of that. This slide, for example, comes from the US Office of Financial Research. It's the US Department of Treasury. It looks at US money market funds. Now, as a rough rule of thumb, around $5 trillion, which is where it got to over the course of last year, it peaked above that. 5 trillion is around a quarter of US GDP in 2019. So that gives you a sense of the magnitude. That big step up that we saw over the course of last year was really two things. One, it was corporates raising money through bond issuance. Perhaps a lot of it was also precautionary as well as needed. But also you had institutional investors as well taking money out of markets and putting it into money market funds. So there was an element of risk off here. And I think what you can see here is that as this reallocation comes down and as risk appetite improves, continues to improve and comes away from money market funds and goes into risk assets, which risk assets will it go into? This point also, I think, is kind of relevant and echoes the same point. So this is looking at US households' excess savings. So if you think of a baseline, which I've marked on screen there, which is February last year, clearly as you went into lockdown, governments, for very good reasons, stopped consumers spending through effectively a handbrake on normal economic activity. And so very often you couldn't commute to work, you couldn't pay your train fare. There was a net saving boost to household savings levels. And that clearly was very elevated in the early months of the pandemic. It's moderated, but it's still above that February baseline. So you've got households with a significant amount of cash. You've also got a lot of money in money market funds relative to historical levels. Where will this money go to? So if it finds its way into the market, you're looking effectively at a trade-off. Does it go into cash with very low returns? Does it go into equities? Does it go into bonds? And these next two slides are effectively sort of signature slides, which I like to refer to in presentations. And this on the screen here, I think, shows you that third point I mentioned, that third theme. So we have the need for balance, the year of transition, and equities over bonds. And equity over bonds is very much, I think, highlighted by this chart here. So what we've got on screen here, we've got this screen, which is US. The next I'll show you in a minute, which is UK, but this is US. The blue line is effectively the earnings yield on US equities. So it takes the expected earnings over the next 12 months that equities are expected to deliver and divides it by the price, the prevailing price of those equities. So it's the inverse of the price to earnings ratio. The purple line, that's the US 10-year Treasury bond yield, which is just a little bit over 1%. And what's really interesting is that not only does this speak to the idea of relative attraction still significantly in favor of equities versus bonds, but also it I think tackles another point, which is lately people have been concerned about the risk of bubbles in markets. and the concerns of overheating in terms of risk appetite and expectations. I think contrast this back to the 2000 bubble, if you will, and the 2000 you had an inverse where effectively you had 10-year Treasury yields which were 2.5 percentage points above that of the equity earnings yield. This time around, actually, you've got the reverse. If anything, you've got the equity earnings yield 2.5%, if not more, points above the 10-year Treasury yield. So I think there is still a clear relative preference for equities over bonds. Now, that's a relative measure. Now, there is some argument to say, well, actually, how does it work in terms of absolute levels? You know, is it just a question that actually equities are expensive? It's just that bonds are a lot more expensive right now. And I think this really gets back to one of the key arguments which investment strategists and economists are grappling right now, which is the direction of travel for interest rates. And I think on that point, you know, it's important to remember the dot plot. And this is effectively a screen here, which is from the US Federal Reserve, and it basically shows their expectation of interest rates over the next few years. And this latest projection was done in December and updated at the end of January. And you can see here that there is a very clear guidance from the members of the rate setting committee of the US Federal Reserve that interest rates are going to be on hold through to the end of 2023. There are, of those dots, each dot represents one member's expectation of where interest rates will lie at the end of each calendar year. There are a few dots which are emerging, if you will, at the end of 2023, but the median prediction is still very much for no change. And that's a very clear guidance. And you remember midway through last year, the US Federal Reserve also updated its inflation outlook and the way that it would look to treat inflation when setting interest rates. And it moved to an average inflation target of 2%, which meant effectively that it's going to be a lot more tolerant of inflation in the near term before signaling any change at all in interest rates. But let's go back to the earnings yield versus bond yield chart. This was the US I just showed you. This is the picture for the UK. And again, you're seeing a very, very similar message that the earnings yield available on UK equities is significantly above the level available on UK government 10-year bonds. So again, you've got a very clear preference of equities versus bonds. You could also argue that there is an argument in terms of allocation towards corporate credit, and we certainly have a tilt in that favour at Brooks Macdonald. Over the course of last year, we within UK fixed interest exposures, we changed our relative preference away from gilts towards investment grade corporate debt, and that was really simply because of the yield pickup that you can get on investment grade. I think over the course of this year, I think you will see a combination of factors. You're likely to see US and UK and major sovereign yields creep up at the long end. So in terms of 10-year exposures, you'll see some of those yields creep up a little bit. You might see some yield steepening. At the same end, in terms of looking at corporate debt, I think you'll see some pressure for yield compression, which effectively means I think you'll see those yields come down a little bit further in terms of corporate debt. And that, I think, will support both the direction of travel in terms of price of debt, but also I think it offers in absolute terms a pickup over sovereign yields when you're thinking about how to build up your allocation to various asset classes. All the time you're thinking about both relative and absolute measures, and across the piece, you know, when we're thinking about yield, we're also thinking about allocations towards corporate credit, but also alternatives as well in terms of convertible bonds and the yields available on those, as well as the effective yield available on equities. So, you know, there is still, you know, in terms of this message of equity over bonds, there is still, I think, very clear evidence to support equities as a relative preference in terms of asset classes. The other big subject I want to get into, which I think is important, is inflation. And I'm sure some of you will have been following US inflation data yesterday, which actually disappointed and was rather muted. And so that's called into question the speed of the reflation trade, if you will. But let's just go on to inflation briefly and just cover a few points there. I've had a very simple message on inflation over the course of the last year, and that is, I think, policymakers through the pandemic, be it monetary policy accommodation, be it fiscal policy accommodation, it's been very much around providing an inflation bridge over deflationary risks. You know, through a pandemic, because of the actions that are taken in the pandemic, when workers are forced to stop working, when consumers are forced to stop spending, those two factors are very much net deflationary forces. And so what you've got is governments which are actively trying to provide a bridge over deflationary risks. They're not setting out to drive pre-pandemic inflation rates materially higher. And on screen here, you can see headline annual inflation rates, year-on-year changes. And the Eurozone, in the latest reading, which is not on this screen, just popped back into positive territory. But for the previous 5 months, it had year-on-year negative inflation, so deflation year-on-year for the previous 5 months. So even despite that huge accommodation, inflation has been pretty muted. Now, as we look forward, inflation expectations have recovered, and I think this is exactly the bridge that policymakers were trying to achieve. You can also see similar echoes to that during the global financial crisis, for example. You have a very quick pull down in expectations. Policymakers step in, provide huge accommodation. You have a very quick recovery, which is the intention, I think, frankly. And thereon, after that, inflation becomes more of a tug of war as policymakers transition. You know, that second thing I mentioned at the start of the presentation, how policymakers transition to a new normal and how they think about financial prudence and so on and so forth. So what we've got at the moment is, I think, you've got perhaps a near-term overshoot of inflation in terms of expectations. Certainly, you've had that recovery. If you think about it in the terms of the longer-term ranges, and I've deliberately showed that on the screen here, so the last 15 years or so, you're back to sort of middle of those longer-term averages. Where they go from here, I think, frankly, over the next few months, you could see a risk. I've called it an inflation head fake, and that's effectively an expression where I'm suggesting that you'll see some near-term inflation pickup, which may confuse the market, and the market may think that this is, and the market may read this as a longer-term inflation signal, but it's not. I think it's much more of a transitory, temporary effect. If you think of energy prices, for example, as we go forward over the next few months, the year-on-year comparatives are going to look very, very strong indeed. Remember, back in Q1 and Q2 last year, the oil price was very, very weak. So by definition, oil prices this year compared to the year ago last year, that rate of increase is going to flatter, and that's going to push up headline inflation rates. But once you're through that sort of transitory adjustment, I think you'll see inflation come down again. Or at least moderate in terms of its pace, and that I think is key. The next few slides I've shown before, and these are refreshed, but I think they speak to the same message about inflation. And inflation really, to become an enduring theme, inflation requires sustained pressure in terms of price rises. Inflation isn't about a one-step change in price. Inflation is a continued, durable pressure on prices. So I've got a couple of exhibits here which hopefully illustrate the point. But the first one is looking at US money supply. So this is looking at M2, which is a narrow measure of money supply, and it looks at both money available for spending immediately, so in your current accounts, for example, as well as near money. So thinking about savings accounts, for example, which you can cash in relatively quickly and add to spending funds. And what you've seen here is money supply significantly increased over March and April last year. as the Federal Reserve, as central banks ramped up their quantitative easing programs, they bought government sovereign bonds, and that cash got injected into the economy. There was a significant step of money supply. But in terms of looking at the pace of that money supply increase, and this is the key point, in terms of inflationary pressures, you're looking for continued pace of price pressure, if you will. Over the latter months of last year, that monthly change in empty money supply has really moderated, and arguably the latest sort of numbers are not dissimilar to what we've seen over the last few years. So again, I would just question, to really see that inflation pressure pick up, I'd want to see those rates much more elevated. The same message really is in terms of central bank balance sheets. The US is a prime example here, and this is looking at the size of the balance sheet. So as a reminder, when the Federal Reserve creates electronic money, it uses that to buy US government bonds. It puts those government bonds on its balance sheet, and therefore the balance sheet grows. There are other moving parts as well, but that's probably one of the key determinants. And over the course of the end of last year, that weekly change, this is quite high frequency, it looks at weekly percentage changes in the balance sheet in the Federal Reserve. The latest readings are again quite muted. So you've had a huge step up in March, April last year during the height of the pandemic, when there was no vaccine hope and we weren't quite sure what we were dealing with. And there was a need to really support market risk appetite and sentiment, which is what the Federal Reserve delivered. But the latter months, I think you've really seen a significant moderation. And I think that speaks to the idea, again, of an absence of sustained pressure for prices. The big elephant in the room, if you will, I think, though, is looking at output gaps. Now, I'll just quickly define what I mean by this, because it's a term that economists refer to, and it's not often explained. But an output gap, an economic output gap, simply measures the difference between what an economy is producing right now and what's its potential economic output is. So at times when you come out of a recession, or when you've had a significant impact to economic activity, unemployment rates are elevated, for example, people are out of work, they're not working full hours, the economy is operating below its full potential. If you imagine over the next couple of years, everyone gets back to work, the economic output recovers, and you're getting closer and closer to your potential output. The US Congressional Budget Office, the CBO, at the start of February, put out its latest judgment of the US output gap, and it determined that the US output gap is not going to close until the fourth quarter of 2024. So effectively, you've got a significant output gap at the moment, which I think at worst was around a 10% output gap. I think over the course of this year, it's going to finish. So this year, in 2020, you're looking at around a 4.5% output gap, which will narrow over the next 4 years. But the key point I want to get across here is that with such a large output gap and with unemployment rates still elevated, that's going to be a real absence of pressure on wages, for example. People are going to price themselves into work on balance, rather than have the pricing power, if you will, to actively campaign and push for higher wages in a tighter labour market, which you don't have yet. So and I think there's a lot of flux around that. Certainly in the UK, as the furlough scheme is expected to end in the next couple of months, there'll be questions around whether you'll see a blip up in terms of the unemployment rate, which is being artificially held back by schemes such as the furlough scheme, for example, right now, which is probably putting off decisions by employers to maybe reassess their the right size of their workforces over the next year or 2 years. But this, I think, is a really important point. This is the elephant in the room. This is the speed at which unemployment falls and how permanent unemployment falls back, the speed at which the output gap closes, the speed at which economies can recover. Those things will have a big bearing on inflation. So nobody has a crystal ball, and clearly we keep our eyes open, and we're mindful of the risks of an inflation becoming stronger than we or others anticipate. But the evidence is not there yet. And certainly when you look at this chart, for example, this is looking at monthly changes of wage and salary disbursements. And you can see here, this is looking at US wages, big step down in the pandemic. There was a recovery, but again, the pace of wage growth has really moderated again. So it comes back to, I don't wish to be a stuck record, but it comes back to this sense that if we are preparing for a period of higher inflation, and obviously you would need to have significant adjustment in our asset allocation and how we shape our portfolios, that would be driven by the last 3 or 4 charts I've shown you, showing a materially different picture. You'd have much stronger wage pressures coming through. You'd have sustained pressure in terms of money supply growth, for example. You'd probably have sustained pressure in terms of growth of central bank balance sheets supporting markets and supporting asset price inflation. You'd have a tighter recovery in terms of employment. So all these things, I think, would be showing a very different picture. One slide I just want to pick on, which is looking at the yield curve. So when I talk about the yield curve, I'm talking about sovereign government bonds, and I'm talking about the yields available in the short end, so the 2-year level, and also yields available at the longer end, say the 10-year level. As a shorthand, you can take a judgment around the market's expectation of recovery by looking at the steepness of the yield curve. So if you take the yield on 10-year bonds and you deduct the yield on 2-year bonds, you get a 10-year minus 2-year yield gap. And right now, in the US, that's around 1%. So the yield available on 10-year bonds is around a percentage point higher than the yield available on 2-year bonds, for example. Now, as a note of caution, and I wrote a detailed article on this, which is available on our BM Insights website summer last year, where I said actually just be careful of reading too much into government yield curves and government treasury and government bond markets. And that's because of the level of distortion right now. So in terms of the huge amounts of QE that governments have engaged in and re-engaged in over the course of the last 12 months to support expectations and support asset markets, they've taken a significantly greater share. So the Federal Reserve has around a 20% share of its treasury market. The Bank of Japan has around 50% plus. The ECB is likely to have over 40% of German bonds by the end of this year. And the Bank of England has around 45% of outstanding gilts in issue. QE, the Bank of England's QE program is 895 billion. Of that's 20 billion corporate bonds, 875 billion gilts, so 875 billion against a total debt of gilts outstanding of around 1.9 trillion. You're talking around 45%. So when the central bank owns 40%, 45%, 50% of its sovereign bond market, you'd have to argue how much of that is genuine price formation, how much of it is being impacted by a very large owner stroke buyer, and therefore you probably have to have a pinch of salt in terms of how much of an unadulterated pure economic signal our bond market's telling us. Before QE, before central banks took significant shares in their government bond markets, you could argue the steepness in a yield curve was a shorthand proxy of future expected economic growth. If economic growth picks up, then by definition you'll need interest rates to rise to stop things overheating and to set an appropriate level of monetary policy, and therefore the steepness of yield curves was a shorthand for economic growth. This time around, I think actually there is competing signals at play, and actually I would also contend that I think there is probably a cap on how much yield curves will steepen. I think when you think of longer end borrowing costs, that effectively is a real cost for businesses, and I think central banks will act to make sure that those yield curves do not steepen too quickly, because if it does, it will effectively derail the speed of the economic recovery. I think there's been, I forget the numbers now, but I think there was some quite nice arguments for saying that if you had an X% rise in US yields at the 10-year level, because of the cost of servicing that debt for governments, effectively it was equal to the budget of the US Navy in one given year for X% rise in a yield curve. So, the point is that as yield curves steepen, that's a real cost to governments and businesses. And by definition, if you're having to pay more cost to service outstanding debt, it crowds out investment, it crowds out support for jobs and wage increases and general economic activity. So I think central banks will really weigh on how much accommodation, how much yield curve steepening they're likely to allow, and I think you may still see a moderation there. So just in terms of one of the key themes I wanted to touch on, the need for balance in portfolios, barbell strategy, what does that mean? So just as a quick recap, let's look at last year and look at the performance of last year. And on the right-hand screen, you've got the full year 2020 performance. On the left hand, you've got the calendar fourth quarter of 2020. And you can see here how the enduring theme of last year as a whole was very much towards technology, healthcare, the US, the more growth exposures within Asia, Japan, for example, and technology stock exposures there as well. In Q4, you saw a different leadership. You saw emerging markets come to the fore as well. You also saw a much better showing from UK risk assets as well. And also Asia, Japan did very well, but also I think within Asia, Japan, it was some of the more cyclical exposures and value exposures in that region, which also performed as well. But what was particularly pleasing is that given as a house, we have our barbell strategy where we have a positive outlook on US, but also a positive outlook on Asia, Japan as well. Asia, Japan, which is one of our key overweights, performed very well, both throughout the whole of last year, but also in the fourth quarter as well, as you saw that recovery in expectations delivered by those three sort of vaccines that we saw announced during November. Vaccine Mondays, weren't they? November the 9th, November the 16th, November 23rd. You had Pfizer, Moderna, and AstraZeneca, Oxford, come out with very encouraging vaccine efficacy levels. But Q4 did see a rotation into economically sensitive stocks. This year, you've seen a return back to pandemic winners and losers, if you will. So you've seen more cyclical areas such as the Eurozone, for example, where we're still quite cautious, be one of the weaker regions globally. But you've also seen EM perform and Asia Japan perform again, and that's also the growth elements coming through. The US, I think, hides the balanced performance in this chart between growth and value. Within the US, technology stocks were hitting all-time highs again in January. So there has been a return to pandemic winners, and I think this 2 steps forward, 1 step back again really impresses the point about needing balance in portfolios. This chart, I think, just makes the point looking at Europe here and looking at COVID winners and COVID losers. The COVID winners in this case on the left-hand screen is looking at stocks such as tech stocks and online retailers. Losers are sectors such as transport and energy stocks, for example. And you can see here on the right-hand screen, the picture there is very different to the November on the left-hand screen. So November on the left-hand side, you can see a real pickup in terms of those COVID losers, where suddenly there was, I think, a real sort of knee-jerk as a lot of the value, a lot of the cyclical exposure, which had been under huge pressure last year, was very much unloved, under-owned, and saw a big snapback in November. But if you look at this year, that performance has stalled and actually slightly gone into reverse as well. So it reminds you that this is not a time to try and make a very clear bet in terms of having all your eggs in either a value cyclical recovery basket or a growth defensive basket. I think the need for balance between the two is very, very important. This slide again just shows you the same picture. Look at European equities middle of the screen. In January, it's given back more than it made in December, for example. Again, what's very pleasing is that Asia, Japan, one of our key weights, has delivered pretty encouraging performance in both months. So if I just go on to this slide, I think this slide hopefully shows you how we're trying to think about balance. We had an asset allocation meeting back in January whereby we decided to increase the tilt away from international exposures, excluding thematic plays such as tech and healthcare sustainability, and put that into Asia Japan equity with a real clear guidance for investment managers to direct that more towards cyclical exposures. And all the time we're thinking about the balance between the two parts of our asset allocation. On the one hand, you've got those tech, health, sustainability, US exposures, which are, I think, more of a structural allocation. I think longer term, hopefully some of the charts I've shown you, longer term, I think there is still reservations about whether or not this is a new investment regime, whether we're going to see escape velocity on global economic growth, or whether actually the pandemic effectively was an interruption, and actually once we're through the pandemic and through the worst of the pandemic, we're going to return to an environment of moderate inflation, low interest rates, low global growth or moderate global growth. And in that situation, with growth scarce, growth becomes and maintains its value attraction. And so that's the one hand. On the right hand side, that sort of structural argument. The left hand is that nod to November, the idea that you can see very, very quick appreciation at times when the markets recalibrate their expectations about a recovery from COVID, and it's important to have some of that exposure, some of that balance. So again, that's having our UK exposure, where, for example, we increased our UK exposure at the start of last year, and actually against our benchmark PIMFA, where for medium risk portfolios, they actually reduced their benchmark guidance on UK weights at the end of last year. We've maintained our UK weight. So by definition, relatively speaking, we've actually increased our relative weight relative to benchmark for UK, just by virtue of the benchmark changing. That UK exposure in absolute terms, or the Asia Japan cyclical exposure in relative terms, gives you, I think, some insurance that if you do see a quicker pickup in global growth, a quicker pickup in inflation expectations, or indeed a shift in interest rate expectations, albeit moderate further down the road, we have some exposure to that, if you will. And I think that's really, really important. Just a few things to cover off before I maybe open up to questions. First of all, just thinking about the US earnings season so far, clearly the US leads other regions, so usually quite a good guide, a good handle on which sectors are performing. And when this snapshot was taken in the middle of the month back in January, is very much technology again that was leading the positive EPS guidance. But alongside that, you also saw industrials again. So again, this is almost a perfect encapsulation of the need for balance. Tech on the one hand, but also industrials seeing a recovery in terms of expectations around more cyclical exposures. What else would I highlight? Let's have a look at this slide. So as a reminder, there are a number of risks out there. I think I've got through the whole presentation without talking about Brexit. Clearly, that there is a lot more certainty around Brexit now, especially with the deal for goods. Clearly, services and financial services remains very much a question, but I think there is still guidance to reach some sort of understanding by the end of March. But we'll see if that date slips. But in terms of issues now, I think inflation is clearly front and center. as one of the key narratives for this year. I think a lot of that is also around the result of the US elections and policy response. It's interesting, isn't it, that the markets now have reverted back to sort of a Goldilocks and three bears analogy, whereby they'd like a significant amount of stimulus from the new Biden administration, but they're very keen not to have too much stimulus, lest it drive a push on inflation in the near term. But even then, frankly, I think there are still question marks around how that might translate. You know, if you see stimulus checks, do US households save it or do they spend it? And those actions will have clear impacts for inflation one way or another as well. But I think hopefully I've painted a reasonably broad picture. You know, to come back to those three themes again: the need for balancing portfolios, the barbell strategy between growth and defensive exposures on the hand and value and cyclical exposures on the other. And those can, I think, quite helpfully, comfortably coexist this year. The need to be mindful that there will be transition risks. There may be opportunities to use cash exposures, for example, and re-enter markets if we have a pullback, if there is concerns around transition of policy from a pandemic to a post-pandemic world. But overarching all of this is this construct of equities over bonds, and that when you take a step back, you know, earnings yields versus bond yields, they don't give you a time mechanism, but they do give you a sort of a roadmap in terms of how you want to think about your relative positioning over the next year. I'll stop there if I may, and just throw it open to questions. But hopefully that was helpful. And apologies for the slide and voice interruption earlier on in the presentation. So do we have any questions?
You might want to bring your video back on as well, Matthew, if you don't mind.
Perfect.
Yeah. Any if anyone has a question, if they can just unmute themselves and fire away. No, silence, I think. Always worth giving it a moment just in case the technology's tripping us up. That's fine. So yeah, Matthew, just one question, please, from me.
Yes.
Which is, if there's obviously been some increasing coverage about, you know, in environmental impacts on our world, and the impact that might have on the way that governments start to look at their sort of policies, maybe fiscal policies in particular, where they incentivize or de-incentivize activity. Do you see that having any sort of relatively short-term impacts on investment strategy, or is it still not short-term enough to affect how we think of different regions or sectors?
I think that's that's going to be a very much an enduring theme, and there are so many different touch points you can take on that. I mean, the first, as we've highlighted before, towards the end of last year, we took a deliberate decision to increase sustainability within our asset allocation. So we have three themes now, which is technology, healthcare, and sustainability. And that was very much a 3 percentage point allocation across the board, across risk profiles. And it was a representation. It was more than just virtue signaling. So clearly, Brookfield will have a very advanced responsible investment service, which promotes two policies of advance and avoid, and Ben Palmer there does a very good job of articulating the drivers behind that. I think in terms of for me, asset allocation, I think there is a clear amount of money that's going to be needed to commit. I mean, I think you're talking, trillions of dollars a year globally in terms of achieving a sort of a longer term sort of net zero target in terms of emissions. And for that to happen, there's got to be a significant amount of net investment in the space. In the short term, there's going to be sort of constraints. So there will be simply not enough companies, not enough investment opportunities to find, and therefore that creates a very positive supply-demand dynamic. So on the one hand, it was an acknowledgement that I think there was going to be a lot more interest and a lot more asset allocation coming into this space that we would benefit. So there's a technical support. But also I think there is going to be a greater investment as well. And in terms of our end clients, I think there's lots of evidence which suggests that this is much more of a topical issue for younger generations of investors, and they're more informed and more aware of the environmental challenges which are pressing on our world, and those need financial solutions. So I think those are all quite important as well. I think I think in terms of investment, it's very clear. We've got the UK budget on the 3rd of March, and frankly, we may get some early signals on the 22nd of February when there's every chance, I suspect, that Rishi Sunak, the Chancellor, will probably share the podium with Boris Johnson when he has his table 22nd February, so roadmap out of lockdown as his next guidance. So we may hear more there. But I think that's going to be, despite his expectations, I think the Chancellor around budget will have to still be giving a lot more than he'll be taking away. And I think there'll be a significant element and stress on investment and supporting sustainable investment as well. So I think this is a direction of travel rather than a significant sort of step change in the very short term. But you are seeing it. The US rejoined the Paris Agreement, for example, on Biden's first few days in office. So I think sustainability is going to become a much more dominant theme over the coming years, and it's important to have exposure to that for a number of reasons. I mean, there is also there's so many different areas that it touches on. I mean, just as a side shoot in terms of cryptocurrencies, for example, and this has been, thinking about what's been happening there recently with Bitcoin. There is a very sort of a real impact in terms of ESG impact on Bitcoin in terms of the cost, the computer cost that's needed, or the computer power that's needed to generate and sustain certain cryptocurrencies, for example, which I think will be coming to focus. And that is also going to shape. So you're going to find sort of ESG shaping all manner of sort of investment allocations, investment decisions. But we've tried to give a very clear signpost, I think, within our asset allocation by allocating that sustainability theme across the risk profiles.
That's great. Thank you, Matthew. Appreciate that. So, ladies and gents, it just remains for me to give thanks to Matthew for another interesting presentation, giving us all things to think about as regards the investment environment. Thank you, Matthew. It was excellent. You mentioned the budget,
Yes.
and interestingly, our next seminar is about that. Unusually, given what's happened in recent years, the budget on March the 3rd could actually be interesting this year for probably unfortunate reasons. Our K. Johnson G's tax partner, Alex White, will be leading a seminar the morning after the budget. So 9 a.m., excuse me, on March the 4th, to summarise and discuss the changes and impacts of that. So please join us for that if you can. So it just remains for me to thank everyone for taking part. Thanks again to you, Matthew. It's much appreciated that you spend the time with us this morning. And we have been K. Johnson G, helping you build a better business. Take care, everyone.